At this point, I'd like to turn it over to Dean Don Molliver, who I thank for his support and for our introduction. Don?
Thank you, Rick. Good afternoon, everyone, and welcome to the annual H.R. Young Lecture Series. Ray Young was a revered trustee of Monmouth University, and professionally, he was a director and partner at Goldman Sachs, when he retired after a 40-year career at Goldman. His partners made a gift to Monmouth University in recognition of his passion, which was education. And that was the genesis of this annual lecture series. So keeping with the tradition, I'm pleased to introduce Esther George. Esther is the president and CEO of the Federal Reserve Bank of Kansas City, where she leads a workforce of nearly 2,000 employees. I have 40 faculty, and I think my hands are full. I can't imagine, Esther, what it's like to work with 2,000. So at the Kansas City Fed, she and others conduct monetary policy. And as the 10th Federal Reserve District representative, she serves on the Federal Open Market Committee. She provides financial services to over 1,000 banks in her 10th district, as well as the U.S. Treasury. Finally, Esther is a leader in the development of FedNow, institutions to settle payment in real time, 24/7. She also hosts an annual economic summit in Jackson Hole, Wyoming, which includes academics, researchers, and central bankers who discuss leading topical global issues of the day. So Esther, we welcome you. We are honored to have you in our presence, and we look forward to hearing your remarks. And I'd finally like to just thank Rick for putting this program together. Rick serves as a specialist professor in economics finance in our school, and we are delighted he was able to make the connection and you're able to grace us with your presence. So we look forward to hearing from you. Rick?
Thank you very much. It's an honor to be here.
Thank you, Esther. I'd like to echo Dean Molliver's remark and welcome you to virtual Monmouth. I know you know of the university. We spoke of it briefly before me joining the team here. And I sure hope when COVID passes and the next time you're at the Fed New York that I can get you down here to show you around and you firsthand see some of the exciting things we have going on across campus and importantly in the business school. So thank you for joining us, Esther. I appreciate it. Before we get into the challenges of the COVID economy, et cetera, I thought I'd start, since we have a number of students in the audience. In fact, the bulk of the audience is made up of students. And by the way, audience, please submit your questions in text and identify yourself and your affiliation with the university, if you have one, along with the question, okay? Your name, who you're affiliated with, and what your question is. Towards the end of this session, we will be picking a few questions to ask President George. But anyway, Esther, before we get into the big, the juicier COVID economy type questions, I thought I'd like to take a step back and talk about the mission and purpose of the Fed and the structure of the Federal Reserve. Importantly, the role of the regional reserve banks. Of course, you're president of one of them, the Kansas City Federal Reserve Bank. Of course, the Fed has a handful of important functions that most folks are aware of: monetary policy, stability of the financial system, safety and soundness of institutions. Probably less known is its role, and I hope we get to touch on this later because you are a leader within it, fostering payments and settlement system safety, and also promoting consumer protection. That was a outcome of the 2008 crisis, as I recall. Would you mind taking a few minutes and commenting on those items' importance in your mind?
I will be happy to do that, Rick. And let me first say, Professor Rick, how nice it is to see you again. It's been a long time since we worked together in Kansas City. But I think you've started in a good place. So talking about what the central bank does and what the role of the regional banks are, I think is a good foundation before we think about what role it plays in today's economy and how that looks. As you outlined in those opening remarks, the central bank's job is by and large to serve as a source of stability to the economy in terms of thinking about a stable financial system, in terms of price stability in the economy, ways to foster its sustainable growth. And you might think of the structure of this institution as really unique in many respects around the world. And that's because the current iteration of the Federal Reserve is really this country's third attempt at a central bank. The first two didn't outlive their initial charters because, in my view, they were monolithic institutions. The public found reason not to trust them. And so when Congress came back around after a series of banking panics and other things to say, is it time for the United States to have a central bank? They created a version that I think has both elements of what Americans typically expect, and that is a high degree of accountability. So this is an institution that has accountability to Congress, but it is also decentralized. So there are 12 reserve banks. One of those is here in Kansas City as a way to connect this institution really at the ground level to the economy and those functions you talked about. So the way we carry out monetary policy benefits enormously, in my view, from having those connections in local communities. Our ability to oversee the financial system, again, benefits from understanding the economic context in which those institutions operate, the risk around that. And then finally, our third key role is around the integrity of that payment system. And the functions that we carry out all work together to make sure that we are a source of interaction with our economy that brings stability.
Well said. Regarding the structure of the Fed, as I speak on markets to my students, I say, think of three things: the Board of Governors, the FOMC, and the regional reserve banks. Think of those three chunks, if you will. Let me start by touching on each of those and start with the regional banks. What's your view of the importance of the Fed's dispersed structure that you just laid out and the regional reserve banks?
So at one level, the regional banks serve as the operating arms, if you will, of the Federal Reserve System. So you will find going on at the Kansas City Fed, as well as across others, cash vaults, providing currency to financial institutions in our region. You will see us operating the payment system and providing financial services to the banking system in this country. The examiners that are looking at financial institutions, by and large, are coming from the communities in which those institutions exist. And then, of course, as it relates to the intersection with monetary policy, you will find me being advised by a staff that both talk about what's going on in the region that I serve, and in my case, it is a 7-state region, as well as presenting a view of how that fits into the national economy, and frankly, in today's world, the international perspective as well. So those 12 regional banks are really connected in their communities. They are bringing really grassroots context to the work they do as they intersect at the national level.
Okay. Now on the FOMC, the monetary policy making group of the Fed, if you will, you are on a 3-year rotation, correct?
That's correct.
So you attend all meetings, but in terms of voting, you are not voting this year, you will vote next
So yeah, you're right. The context on the FOMC is it's a large committee. It includes the members of the Board of Governors. It includes the 12 Fed presidents. The governors always vote. The New York Fed president, as you well know, always votes. The other 11 reserve banks rotate their vote. And so in my case, it means every 3 years, I rotate that vote with San Francisco and the Minneapolis Fed.
Mhm. You indicated that staff inform your view to prepare you for monetary policy meetings. What type of staff are these? Are these largely economists? And do you get out and about within the 10th district, across the 10th district, to talk to individuals to see what the situation is?
Yeah, so my views at the monetary policy table are informed really in two ways, I like to tell people. One is I have a small staff of economists, and their job is to help me understand the data. They do a lot of research. They think about how that data is coming together, what its trends are, how it informs our view of whether we are moving to achieve our mandates set by Congress. So that staff is highly influential in informing my perspectives on how the economy looks. But I will also tell you, as you well know, that information by and large is backward looking. And so to complement the perspectives at that table, a regional Fed president will spend a lot of time talking to a number of contacts in their region. So you will find me talking to manufacturers, to hotel owners, small businesses. We're engaged with leaders in the community that are serving low and moderate income communities. So trying to understand that full range of inputs to our economy really give you the context. And the other thing they do is they give you a forward look at the economy. So when you put those two things together, the data, the perspectives of a staff that are advising you on that data, along with the anecdotes you pull in from the public, it really arms you when you go to that table with what I think is a very broad and informed perspective on how the economy is doing.
Thank you, well said. Speaking of the economy, let's get into COVID. Before so, let me back up to the last crisis. And we thought that was a big one, right?
It was.
2008 Great Recession, as they call it. I don't want to be backward looking. I bring it up just to raise it to see if we learned anything that can be applied in the current crisis. So as you recall, we fell into what appeared to be a fairly deep recession. I don't know, maybe we got to negative 8.5% real GDP growth or so. Now we see minus 32 or whatever it was perspective. But we then came out of that recession, as I recall, in mid 2009, possibly the business cycle dating people at the NBER identified that in 2010. But regardless, some of the really good things that we did up front in that recession, the Fed did up front in terms of accommodative monetary policy, lowering the Fed funds rate to near zero, flushing the system with reserves through what then was called the large scale asset program, later came to be known as QE. Did some good things. We came out of the recession. However, we continued to hold interest rates low for another 4 or 5 years plus. We continued to add reserves to the economy through these so-called quantitative easing, QE efforts. And I'm wondering if we learned anything from that, since we're basically running a type of that same game plan with this crisis, whether, and we're not there yet. It's, we're not at the end of COVID yet, so it's not time to start thinking about normalizing yet, but did we learn anything from the 2008 crisis in terms of the timing of normalization? Should we have lifted off? Should we have begun to tighten policy a little bit sooner than what we did.
So there were lessons learned from that period, I think, for sure. And some of those are being applied today. Some of those we're benefiting from. So let me just say, for example, the last crisis involved really a set of institutions that were undercapitalized and had to be recapitalized by the taxpayer. I think that led to understanding that having stronger levels of capital were essential to the stability of the economy and to the ability of our banking system to be able to provide credit, which is particularly important during a downturn. Obviously, the actions that the Federal Reserve took at that time were what I would have called experimental. You heard these large-scale asset purchases being described as unconventional, and indeed they were. But through that experience, I think what you see now is thinking about how to deploy those in the economy today. First, to provide stability to market functioning. You'll remember early in this COVID downturn, markets panicked, and having the capability of intervening in those markets, I think, was essential to bringing them to a more stable place. I think your question gets fundamentally at, in my view, what are the costs of policies like this in the long run? And how do decisions in a low interest rate environment, one that expands the central bank's balance sheet, ultimately play out? And I would be the first to say, of course, there are risks. You will see in the FOMC minutes, the committee talking about the benefits of these policies and also trying to understand their risk and their cost over the long term. So low for long does create incentives. I might argue one of the things we saw ahead of this pandemic was the level of corporate debt. So in a low for long environment, it is one that encourages risk taking, it encourages leverage. And you often don't see that until there's a turn in the economy. And it's only then that you're able to see, was that an accelerator? Was that something that proved to be destabilizing to the system? And I think we'll be looking at those issues for some time, including the Fed's balance sheet, which now, of course, people were talking about a Fed balance sheet of $4 trillion at one point. It came down a little bit below that. We're now to 7 trillion. And as you know, today is not the time to be trying to figure that out, but that time will come soon enough, I'm sure. I hope the economy will turn in a way that it turns our attention to that.
I hope so as well, and quickly. Certainly the Federal Reserve has done a lot. Their quick reaction, I'm very proud of my former colleagues. Which of the programs have you seen the fruits of in your district? Is there a particular program or two that you're particularly proud of that has really yielded dividends, such as the small business lending program or others?
Yeah, so I think when I think about the actions that the Federal Reserve took, I think of those in three parts. So one is our very traditional and what I call our primary tool, and that is interest rates. So when you bring interest rates down to near zero, you do see in my region, for example, housing, you see a lot of mortgage refinance where people are able to take advantage of those low rates. We see that come through in auto purchases and other aspects of goods that people may be buying where they rely on low rates of interest. The other aspect, of course, is one we just talked about, which is the balance sheet policies, the large scale asset purchases. And again, those have been effective in my view in terms of stabilizing markets. They're keeping longer term interest rates and financing conditions accommodative. And then the third thing are these special credit facilities that we are doing in partnership with the Treasury. You might suspect that in my region, where you will find a lot of small banks, you will find a lot of small businesses, that the Main Street Lending Facility, the SBA's payroll protection program have been particularly useful, I think, in trying to sustain some of these small businesses during a very difficult time. The other one I would highlight is the municipal finance facility. Again, not one where you've actually seen a drawdown on the facility, but you have seen that its presence as a backstop has helped lower financing costs in a way that I think has allowed state and local governments to take advantage of that environment.
So certainly the Federal Reserve on the monetary policymaker side of the equation acted promptly, successfully. The fiscal policymakers up front acted quickly with a spend bill. I view that more as support dollars, not a true stimulus bill, but money to keep key parts of the economy above water so that when they're done tumbling down the COVID recessionary slope, they're able to join back up as an economy and grow forward. However, that was part one, and we have not seen part two from the fiscal policymakers yet. But I noticed that Chair Powell, possibly you and others, are doing a fairly healthy job of nudging Congress to move, or at least I interpret it as that, on the fiscal policy front. Is my read correct?
So I think what I heard the chairman saying and some of my colleagues is a couple things. First of all, as you well understand, it is not the Federal Reserve's job to advise Congress on what they should do with fiscal policy, and you won't find us doing that in this case either. I think the observation, though, is when we look at the third quarter bounce back to a very deep hole from the second quarter, you have to attribute both the combination of monetary policy, but the very swift and massive reaction of fiscal policy to help achieve that outcome. As we see some of those things fading on the fiscal side, I think the question is the source of the problem, which I call the pandemic, the virus, is not over yet. We still have a public health emergency out there. And the question is, what will sustain the economy beyond what the Federal Reserve is doing and what fiscal policy has done to date? And so in that sense, I think it's simply an acknowledgement of how important that was to the outcomes we've seen. And I think an expectation that absent the virus disappearing tomorrow, we will probably have to think about what sustains the broad cross-section of the economy going forward.
And something that will assist in that regard may be additional fiscal policy.
It absolutely could be.
Correct. Yes. He speaks it in true Fed speak. I believe he's very complimentary of round one and mentions that another round wouldn't be such a bad idea, but does not directly order them to pass a fiscal policy bill as you indicated. Speaking of the economy, what is your current view of the economic outlook? Geez, we had that big bounce back quarter three. How is one to interpret that number? So much intervention by the monetary and fiscal policymakers nudge that number higher, I'm sure. So how is a layman to interpret that big bounce back?
So I think we should all be encouraged, and I will tell you, I am encouraged by that bounce back, and I think a little bit surprised at how robust it was. That is in part because during the third quarter, the economy was able to open up. Businesses were able to open up. People began to understand what they could do to both protect themselves and still get out. And so that combined with the actions of the Fed and fiscal authorities, I think helped achieve that. My own outlook for the economy is the economy should continue to grow, but certainly it's going to moderate. And that was quite a comeback in the third quarter. And so you will see some moderation. I think one of the key risks around that is, again, the path of the virus. And that's something the FOMC has highlighted in its statements for the past months, which is to say, until that is addressed, that remains a risk to our outlook for the economy continuing to expand. And I think one important element of that that makes this recovery really unique is how uneven it is. So if you look at sectors of the economy where people are buying things, if you're buying computers or bicycles or cars, we see a more robust return to that segment of the economy. When you are looking at the parts that really depend on the ability for us to interact with each other, so movie theaters, entertainment, some of the travel venues, hotels, restaurants, those are not having that same kind of response to the economy. And again, that's going to depend on more clarity, more addressing the public health issue before that can come back.
Is getting full control of the public health issue necessary and sufficient? Or do you view it as possibly the case that even after we get control of COVID, we may see some long-lasting damage to the economy?
So I think that's one of the things I think a lot about is will there be scarring to the economy depending on how long this goes on? Even if it disappears in fairly short order, you have to think about things like public confidence. Will people want to hold more buffer of savings in remembering how they were exposed this time? And so you could see that impact the economy. You could find, and when we, again, I mentioned unevenness in this recovery, you only have to look at the labor market and see this. So even as the unemployment rate has come down to just under 7%, we know there are still 10 million Americans that are unemployed today. And that has fallen disproportionately on women and people of color who really are overrepresented, if you will, in terms of those sectors that have been hard hit. The longer they are out of work, the harder it is to re-engage in the labor market. So those are concerns and risk, I think, when we look at how quickly can the economy recover, how quickly can it get back on track, and how can people engage then in the labor force. You do have to worry about some of those risks to longer term effects that turn what initially we saw as a specifically pandemic related recession to one that could be turned into what I call a more garden variety recession, where you get those dynamics that affect the economy.
Regarding some of the unevenness in the labor markets that you brought up, of course, one of the two mandates from Congress to the Federal Reserve, maximum employment and check inflation. You've redefined the checking of inflation. We'll touch on that in a little bit here. Very nicely. The maximum employment prong, do these evenness issues, are they discussed when the Fed is discussing whether or not we're approaching maximum employment? I know there's not a number we're targeting,
Right.
but what about the inequities that you brought up earlier in the labor markets?
So here's, I think, where some of the lessons from the past crisis you will see informing how the committee may think about this going forward. One of the things we saw in the last recovery was thinking about what full employment looked like. And as you know, we put some estimates around what we thought full employment was. As it turned out, the economy was able to achieve a really historically low levels of unemployment, going down to about 3.5% without generating price inflation. And so in the framework review that the Federal Reserve undertook last year, engaged with the public to talk about how we communicate, how people understand it. I think what you see in that work is the Federal Reserve saying picking a number is probably not a good guide. We are going to have to drill down and look across to understand what is broad, and I think the term inclusive employment looks like in the economy. And that may cause the Federal Reserve not to connect so much some of those relationships around employment and inflation, but really gauging those to see how they're performing. So it does mean we'll be looking under the covers of that unemployment rate to try to understand how healthy that labor market is and whether it's on track to achieve its maximum sustainable levels, even if we can't name the number.
Right. Is that a relatively new effort on your end? Drilling into the number to see if there are inequities?
Yeah. So I don't think it's a new effort. I think when you look at labor market data, there has always been an opportunity to segment that data by gender, by education, by uh, race. And so I think that has always been the case. I think it is also well understood that monetary policy's ability to influence employment is really an indirect effect, as I characterize it. There are a lot of things that affect the structure of the labor market and other dynamics there. So it is not new for us to look at that. I think what is new is that rather than saying we have an estimate of a natural rate of unemployment, that you will find us stepping back a little bit and saying, how does the context of the economy look, and how do we see the labor market dynamics unfolding to make a judgment about whether we're getting close to our maximum employment objective.
Okay, thank you. As the economy stands today, do you see any asset classes that appear to be, from your perspective, a bit frothy? If they did exist, would the Federal Reserve comment on them?
So this is the way I think of looking at imbalances in the economy. And in fact, just this week, the Federal Reserve issued its financial stability report, which is a way to look at the financial system across a broad range of entities and make judgments about where are their vulnerabilities. So it is nearly impossible to decide when something's in a bubble, when you are really in a state of imbalance that will derail the economy. But what you can do is look at vulnerabilities, you can look at valuations in asset classes. And so this report attempts to do that. I think that is essential for policymakers to keep their eye on that. And the challenge is we don't have all the levers that control how those imbalances are addressed. Some come from unregulated parts of the financial system, some come from regulated parts of it. So identifying those vulnerabilities are essentially a flag and something to watch. Whether any of those things prove to be bubbles out of balance, unfortunately, you only learn, I think, too late sometimes. So yeah, you won't hear me calling out a particular bubble, but I think that report does a pretty good job of highlighting where some of those vulnerabilities are.
Thank you. International coordination across central banks, more important in the COVID crisis?
I don't know, more certainly when you have a global downturn, if you will, I think you see central banks all responding to their domestic economies. And there is a community, obviously, of central banks that are talking about everything from monetary policy and how each individual jurisdiction is thinking about that to how they supervise the financial system in doing that. So I think you will see today across advanced emerging markets sort of a coordinated effort based on your domestic mandates to respond to an economy that's been hard hit by this global pandemic.
Okay. Recently, the Fed issued, of course, its modified monetary policy framework. Before we get to the details of those changes, I wanted to talk to you about the process that preceded the arrival of that framework. The Fed went across the country holding a number of, I believe they're called Fed Listens events, to hear what society had to say on a number of issues. How was that experience? Was it beneficial or just checking the box?
Actually, I think it was beneficial in this sense. So as a regional Fed president, I might say that's part of my job on an ongoing basis, understanding how the public understands our communications, how they experience inflation, employment, and other things. I think what was different about this, though, was really a more broad-based effort to incorporate the experience we had in the last recovery and to try to engage the public on understanding what does it mean when you hear us talk about inflation. So I'll give you an example. Often when I talk to people and say inflation is low, people will say, really? Because you must not have the same basket of things you're purchasing that I do. So we know that inflation is experienced differently depending on your spending, your income, and other things. Housing, all those things influence how you view inflation and its impact on you. The same with the labor market. I think we heard loud and clear what's most important is the ability to have a job and how that important that is to so many things in the economy. We also did a segment at the Chicago Fed, which also brought in academics and others to understand how we should be thinking about this range of issues. So it was an effort that engaged across the country. I think that's healthy. I think it's always healthy for my colleagues and I to engage with the public to understand what we can do better in communicating, how we understand the drivers of the economy and how we interpret the data we have. So that was really the backdrop to our framework review. And I think it served us well in doing that.
And can you explain the changes?
So there were essentially a couple of changes. One was try to explain in the framework that the general level of interest rates look to be lower today. Number of structural factors, other things may have brought that about, but that's true globally. And that creates a different set of challenges for the central bank in thinking about how to stimulate the economy when you need to, how to think about what normal interest rates are. So you'll see in that one-page document setting the context for how we understand the economy today. And then focusing on the two objectives that Congress gives us. How do we think about maximum employment? And there, one of the changes is we took out trying to reference an estimate of what normal employment would be, and instead say we're focused on broad and inclusive employment in the economy. And inflation was probably the other notable place where there was a change. So no change to the 2% inflation target over the long run. But the question was, can it run above 2% for some period of time so that we achieve on average 2% inflation in the long run? And that is a new approach called flexible average inflation targeting, which in my view means 2% isn't a ceiling. If the economy still has room to run and we tip over 2%, we would do that in the interest of seeing sustainable growth in the economy and labor market improvement.
As long as over that period of time, inflation averages around 2%.
Over the long run.
Over
Right.
the long run, gotcha.
Right.
Okay. What's your outlook for monetary policy?
So the most recent meeting of the FOMC came out suggesting that policy was appropriately calibrated, and I agree with that. I think we are still in a phase of the central bank needing to provide supports, both on the interest rate in terms of keeping financing conditions accommodative and using our credit facilities to the extent they are needed. So I think the calibration right now is appropriate. As we look out, monetary policy will track how well the economy begins to continue its forward progress. Watching the unemployment rate come down, watching growth begin to move back toward trend will all be important factors in thinking about when's the appropriate time to make any adjustments to that, one way or the other.
Uh-huh. Speaking of one way, negative interest rates. Very little interest at the Federal Reserve. Why is that?
I think in part because we've had this experiment in other parts of the world to see that. I think another aspect is here in the US, we haven't really had to face that issue. And I think given the other tools that the Federal Reserve has to accomplish achieving its mandates, that one did not seem like one that would be useful to us. So that's off the table in my view for now.
And the view of all of your colleagues, it appears. Yes. Yeah. Stress testing large banks. I see you're doing a mid-cycle stress test of large banks. Purpose of that, potential outcomes from that.
So the process of stress testing the largest banks, as you know, has been in place since the financial crisis. It has been a mechanism both to give the public information and to inform supervisors about various risks in the portfolios and the operations of those banks. The regular stress test is always a set of scenarios that tries to assume adverse outcomes and how well the banks are prepared. I think the next step is to say, is there something around the pandemic as we move further into thinking about credit quality and how the economy might unfold that would inform regulators' views on that. So as you know, steps taken to preserve capital through limiting share buybacks, thinking about dividend payouts are all important components of making sure that those largest banks have sufficient capital buffers to get through this period.
So the severely adverse scenarios relating to COVID had unemployment topping out at roughly 12%, between 11 and 12% at year end 2021. Should anyone read anything into that?
No, I think the scenarios are always a way, again, by definition, to say under stressful scenarios, is there sufficient capital in the financial system? So those aren't forecasts. They're not incorporated. They're not even set by the FOMC, as you know. Those are supervisory judgments to say what are a range of events that could occur and how does bank capital perform under those. I would also point out those are model-driven assumptions and relationships that come through there. So they are helpful indicators. I think the ongoing business of supervision of these institutions really forms the core of the Federal Reserve supervisory program. And by that, I mean going in and kicking the tires on things and understanding many aspects of those banks' operations. So there's a full set of things that bring perspectives on the strength of our financial system, and having strong capital, we know from 2008 and 9 is essential.
Okay. I've been reading quite a bit about your lead role in the payments arena in developing a new product known as FedNow. I was wondering if you take a few minutes as we wrap up here and explain FedNow, possibly in the context for our students, maybe Venmo, PayPal type context, so we get what FedNow is all about and the pluses to it.
Yeah. So the Federal Reserve has had a role in making sure that when we pay for stuff, we can trust that it runs on rails that get our money where we want. And I think what we've seen in the last decade is with our mobile phones, with the way technology can allow us to transact business. We want to be able to pay for things with the same ease as we can go online and buy things. And so you mentioned a couple of apps that allow people to move money around person to person. The underlying infrastructure for our payment system, though, doesn't work in real time that way. So even when you are trading money with someone on one of these apps, it is running on rails that actually mean the money doesn't settle from your bank to the other bank for anywhere from a day, maybe longer. And upgrading the infrastructure to allow for retail payments to move in real time has a number of benefits. It not only allows that money to move, but think about if you're a small business and you're waiting to be paid. The sooner that money comes in, the quicker you can turn that over into inventory. Some people are waiting for income or checks to come in, that could come in sooner, can have benefits. So the Federal Reserve undertook an effort to say, is it time for real-time payments to settle that way in the United States? The banking system had stepped up to develop a system to do that. The Federal Reserve believed it was important for the integrity of that system and to fill it out. So it wasn't just a group of large banks that could do that with their customers, but frankly, that the smallest institutions and the smallest communities around this country would also have that kind of access, caused us to initiate an effort to build a real-time settlement system for retail payments, where you and I can trade money and have it instantaneously settle out of our bank account. So that effort is underway. It will take us a couple of years to build that out. But we will be doing that with the interest of making sure the country has broad access to that kind of a payment system, that it's safe, and that it can be accessed by everyone.
Okay, that's exciting, and we look forward to it. Couple questions here before we wrap things up. Couple questions from the audience. Where do you see the dollar moving? Strengthening, weakening?
You know, the dollar, since it's not among the objectives that Congress asked me to track, I only look at it to see where it's moving relative to a signal for the economy and other things. So as you can imagine, in today's world of concerns about deflationary pressures and other things, that can move around for lots of different reasons. So it's not something that I opine on or keep track of. We kind of let the Treasury keep track of how the dollar's doing.
Okay, and lastly, you know, as I was driving in this afternoon, I thought of a op-ed piece that our former colleague Kevin Warsh wrote a few years ago, I believe now. Time flies. Among other things in that piece, he had commented on the need for the Federal Reserve to beef up its modeling of the economy. Have you seen any of that?
Well, I think
that's econometric models at the board and possibly at the regional reserve banks.
Yeah. I think it's one of the advantages of having a staff of economists. These are folks that are constantly looking out to say, how can we better understand the dynamics in our economy? How can we build that into our models? And how can we listen to the public and how things are changing to do that? So I think that is always a focus for us. You know, after the last recession, trying to build in financial system dynamics to those models has been progress, I think, in some sense. But it's always our focus to understand how dynamics in the economy are changing. It in part comes through in how you see our framework changes that were recently announced.
And lastly, how do you view the Federal Reserve as a first job out of college, whether at the undergraduate or MBA level?
It is a wonderful place to come to work. And let me just say, it's an institution that both is serving an important public mission, but allows people like me who can come in and understand a variety of aspects of that economy to put their education to work. And importantly, I think to continue to learn. We have a dynamic economy in this country. Our financial system has changed dramatically, and you really have a front row seat to that. So I hope your university will encourage students to consider the Fed for their first job.
Working hard on that and hope to accomplish that in the near term.
Sounds good.
Appreciate your time, Esther. The university recognizes how busy you are and how kind it was of you to take an hour out of your schedule to spend it with us today. Thank you very much.
My pleasure. Good to see you. Good luck.
Thank you, Esther.
All right.